So next up, we have keynote speaker, Brandon Munro, who is the co-chair of the World Nuclear Association, the Nuclear Fuel Demand Group, and managing director of Bannerman Resources. Good morning, Brandon. I'll hand over to you now to provide an overview of the uranium sector and an update on the company.
Thanks very much, Jane, and it's a pleasure to be here. Thank you for the opportunity. I'm very excited to be talking about uranium, particularly in the context of enormous changes that we're seeing in the global landscape with decarbonisation and a push towards ESG. And not surprisingly, this has now flowed through to investor sentiment in uranium itself. These slides are available on our website and we have released them to the ASX platform this morning. So please have a good look at this disclaimer and the next one. Thank you. So what I'd like to do with uranium today is talk you through the big picture aspects of uranium. There's some great sources with a little bit more of the detail on the macro, but this is an opportunity to talk about really key thematic drivers that I think will entirely reposition this sector and see re-rating of equities well beyond what we've seen with the recent flow of funds into the sector. If we start by looking at the core thematics, so what has come together today to make uranium attractive? Now, the first thing to understand is we are a sector in deficit at the moment. And we're running at about a £20 million per annum deficit structurally. In other words, the uranium that's consumed around the world in nuclear reactors is £20 million per annum more than what is mined and what is entering the supply chain through secondary supplies. And that's against a total demand base or a total consumption of around £180 million. So not an insignificant number at all. What's so interesting is last year, we saw COVID disruption to that supply that effectively doubled the deficit last year. And we're seeing some of that supply disruption continue into this year. And we're only just experiencing the world's largest uranium mine start to return to production after losing several months of production. So I'm anticipating about another £10 million of COVID-related supply disruption to the numbers this year. So what does a deficit really mean for us as a sector? It's important for people to realise uranium is an unsubstitutable fuel source for nuclear power, which supplies more than 10% of the world's electricity, and in key markets such as the US is responsible for more than 50% of the current clean emissions-free energy in their grid. So nuclear power is absolutely vital around the world, and it simply cannot function without uranium. This deficit is projected to grow even further, as we'll talk about, and that's because a number of the very largest mines in the world are running out of ore. In fact, 2 of them have already closed this decade, Ranger in Australia and Cominac in Niger. And also the vast uranium producer, Kazakhstan, by the nature of their deposits, they have a depletion tail. So the rate of production from those big deposits starts to decrease. And that will happen in the back half of this decade. So that gap will widen even further. There's very limited new supply coming into this sector, and that's because we've been in a deep, dark, difficult bear market since Fukushima in 2011. And as a result of that and declining prices, there's been very little reinvestment into this sector, very little investment in exploration, very little investment by the majors in development projects. And speaking on behalf of the junior end of the sector, it's been very difficult to raise capital and to justify spending capital on the development of projects over the last 10 years. So as a result of that, we've got a limited amount of new supply that is capable of coming into this market to meet that deficit. And we should also remember that it's very steady growth in this sector. And we'll talk about some of the drivers with that. But in particular, China, India, Russia, and the Middle East are contributing as new demand centres together with that steady demand that I referred to in the Western and developed world, about 10% of the world's electricity, and playing a more important role because of its clean energy attributes. So this is a slide that sets out the demand-supply dynamics in our sector out to 2040. It's from World Nuclear Association, and as Jane said in the intro, I co-chair the committee or the working group that is responsible for determining global nuclear fuel demand out to 2040. So what we're looking at is that black line across the top is the reference case demand that working group determines, and the bar chart running against that is current and expected forecast uranium supply. In the dark blue is mine uranium that's currently in production, and you can just see the extent of that depletion that I referred to previously. On top of that is light blue, which is known as secondary supply. And there is a few categories of prospective mines, including the category of planned mines, which includes our project, the Etango project in Namibia. Those golden bars that sit above the line is restarted idled production. So because we've been in such a savage bear market, prices have been so low that a number of very attractive producers around the world have put themselves into care and maintenance. So MacArthur River in Canada is a good example, and also Langer Heinrich in Namibia. There's a bit of a perception out there that, well, this market isn't going to go anywhere because those mines will just come back into production and they will fill the gap and the price will continue drifting. Well, I think this chart clearly demonstrates that even with the resumption of production from these idled mines, there's still a very large requirement for new uranium mines to come into production. And basically that's what we can see. Now, this report was put out 18 months ago, and a lot has happened in the sector since then. And I've indicated that from the left-hand circle with the yellow arrows there. So first of all, what we can see is that supply disruption from COVID, which I referred to last year and a little bit this year. There's also been some announcements since this report was published that Kazakhstan will continue with supply discipline and continue to withhold supply from the market, which is indicated in those arrows as well. Now, what we can see from this is that pink zone that sits above the bar but below the demand trajectory, that's you can consider that a deficit. We've seen the drawdown of inventories over the last few years. Now, these inventories were built up since Fukushima and have continued to play a role in suppressing prices in this sector. It's my view and the view of many commentators that those inventories are coming to an end. And so as we see those inventories come to an end and we see exposure to the very large widening pink zone in this chart, that's when from 2025 and particular from 2028, there will be a very acute need to bring new mines into production. Now, here's the thing. The current uranium price isn't enough to incentivize any new mines of scale to come into production, including ours. There's a couple of small mines that could possibly make it at current prices, but it's unlikely that they're going to have any real contribution to filling this gap. So what that means for an investor is this is a sector where you can have more confidence than anything else that I see out there in the financial world that prices must increase. And in fact, my belief, having modeled out the sector and being quite involved in various aspects of this nuclear supply chain, is that prices don't only need to increase, they need to more than double in order to bring enough production into the supply chain to meet that pink zone that you can see there. And just for good measure, I've put the uppercase. So the reference case scenario is that dark black line there. If you want to think more optimistically about what decarbonisation and climate change might do for the demand prospects in our sector, you can track the upper scenario. And as you can see on this chart, by 2040, it presents an even more attractive proposition for investors. What I'd like to discuss now is some of the very big picture trends that are driving this sector. And I've identified 8 key thematics that really group into what I think are the 3 biggest super cycle drivers of any commodity in our time: climate mitigation, geopolitical tension, and expansionary monetary policy. So I'm going to deal with each of these in turn, and that's how I would plot them on this Venn diagram of those super cycle drivers. So the first key thematic, which is affecting just about all commodities and all metals, is the fact now that all of the world's largest emitters and largest economies have committed to decarbonising by 2050, or in the case of China, by 2060. Now, this is very significant for the energy market, and that's because for several years, government's response to the climate crisis, the climate emergency, climate mitigation, whatever you'd like to characterise it, was simply to increase renewable energy. Governments figured that that was a fairly easy way of pacifying the concerns of their constituencies, and it was a benchmark that was easy to measure in the short term with very little consequences into the long term. Now what's happened is with climate commitments and decarbonisation commitments, governments now need to be more concerned about electron accounting. In other words, there will come a time when they need to make the books balance on emissions-based industry and emissions-based electricity production. So there's a growing awareness as a result of that amongst policymakers and even amongst politicians that intermittent renewables can provide some of the solution, but they cannot provide the whole solution, despite the best efforts of renewable lobbyists. That's put nuclear power in a remarkably strong position, because nuclear power does generate emissions-free energy, but it does it 24/7 in all weather and climatic conditions very reliably with a huge degree of resilience. And as policymakers start to understand that storage is going to be a slow and expensive process to roll out alongside intermittent renewables, I believe that nuclear energy will therefore have its a real opportunity, a very strong opportunity over the coming decade. The next key driver is the growth of electricity itself. It was only a couple of years ago when World Economic agencies were predicting a decline in electrification and a decline in electricity demand. Very recently, it was all about decreasing consumption as a mechanism for dealing with climate change. Now what's happened is a dramatic reversal of that. Most people would only be aware of it in terms of the electrification of transport, which itself is having a huge impact on electricity demand. And Elon Musk said last year that electrical demand will in fact double by 2040 because of the electrification of transport and EVs. But it's vital to understand that this electrification of everything is moving beyond passenger vehicles and buses and trains. It's moving to industry, even heavy industry, where the world is weaning itself slowly off alternative fossil fuel sources of energy and pushing that energy demand into the grid. The impact of China in this sector cannot possibly be underestimated. They've just released their 14th five-year plan, which has confirmed demonstrably that China sees nuclear power as a very important part of its clean energy mix. And we will continue to see announcements that support that. In fact, just last week, or just this week, China's announced that they have approved 5 new reactors to be built over the next 2 years. And those announcements will come thick and fast over the coming period. It's my modelling and my belief that the extent of nuclear power required in China by 2040 is such that their consumption of uranium on an annual basis will be more than all of the uranium that is mined in the world today. So if I'd give you a moment for that to sink in, by 2040, the world's uranium mining industry will not only need to cater for the rest of the world, but it will need to maintain its existing size just to cater for the demands of one consumer, being China. Now, in the context of that chart that I showed you a couple of slides ago, that paints a very buoyant picture for this sector and what uranium pricing must do to bring that extent of production into the sector. One of the real developments we're seeing in this sector is SMRs, or small modular reactors, and advanced technologies. They're having an impact because they're loosening public opposition to nuclear power in key markets. Now, we have to understand, particularly when we're sitting in Australia, that Australia is still a bit of an island in terms of its opposition to nuclear power, sadly. Nuclear power's got widespread support in the US, in certain parts of Europe, in the UK, and of course in Asia, where its key demand growth projections and trajectory is coming from, Russia as well. But in a number of markets, public support is still not sufficient to generate growth of nuclear energy. And that's what SMRs are starting to do. This is against the background of an overall commodity super cycle and a flight to real assets. And that's a direct result, of course, of the expansionary monetary policies that we're seeing across the globe. Uranium stands to really benefit from that, as hedge funds and other large institutional investors realize that they're running out of bets that have got a low downside risk characterization. The investing in physical uranium, if we can switch to the next slide, is a remarkably attractive investment at the moment because of what I've said before, and it's well understood that the uranium macro points very decisively to increased prices. And what we expect to see is an increased involvement of generalist investors into the equity sector, but also speculators into the physical market for uranium. And you can just imagine, with the type of deficits that I've described, what will happen if we have competing with the consumers of uranium a large flow of capital into buying, for speculative purposes, the physical commodity as well. One thing that you can find if you track some of our public announcements through Bannerman, and if you follow me on Twitter, is I'm a close follower of geopolitical tension in this sector. And it's particularly relevant, partly because we see what I think is the most elevated geopolitical tension since the collapse of the Soviet Union, sadly, but also because this sector is incredibly concentrated. The top 5 producing uranium countries account for over 80% of the uranium produced in the world. And if you go to the top 10 uranium producing countries, that figure goes well into the 90s percentile. And conversely, there's a very big concentration of uranium consumption amongst countries that don't produce very much uranium. So the US, which is still the largest uranium consumer in the world, produces effectively no uranium at all. China produces only a small minority of its own requirements. And the same can be said for France and South Korea, who together with Russia make up the balance of the top 5. Now, that has a big effect on small juniors and other equity players, because when you're looking to settle as a nation bilateral or multilateral geopolitical tension, it makes the sort of numbers that junior miners and junior explorers think about totally inconsequential. And that's where you can have big distortions from an investment point of view in terms of the value that can be paid for certain assets. And we saw that during the last uranium boom. This final point is enormously relevant from where we sit today. And it's the opportunity that ESG investment requirements and the broad trend towards decarbonisation offer not only the nuclear power sector, but uranium investing in particular. Here we've got a sector that sits within the mining industry, but has an absolutely fundamentally positive contribution to decarbonisation. Totally inbuilt within the whole concept of a uranium company is a strong ESG driver, because it can contribute so well to nuclear power. And when nuclear power displaces coal, there's a massive decarbonisation benefit from that. As an industry, we're only just starting to understand that power and just starting to reposition ourselves as ESG leaders. Now, as the industry starts to get that right, I think from investors' perspective, that will create an increase in the flow of funds into our sector. And given that our entire industry only accounts for about $20 billion worth of market capitalisation, as we start to attract even a small sliver of the ESG investment funds available around the world, we can see a dramatic impact from the accelerating velocity of that investment. So I see these 8 key thematics coming together to push uranium as a sector, and particularly as an investment proposition, in a very interesting way, as it correlates and combines with the fundamental macro, ensuring that our sector emerges from a long bear market. So we've got the natural commodity cycle as we move from a bear market into a bull market, and we're starting to see that now. Prices are starting to increase and equities are starting to become re-rated. But then we've got these 8 factors which create an overlay onto the traditional commodity cycle. And uranium's already quite famed for its upside volatility, and you only need to look at 2006, 2007 to understand that. And the reason I'm so excited here is that the interaction of that commodity cycle in uranium plus these key 8 thematics is creating the ingredients for another incredible volatility event, which is, of course, the attraction to investors. So I'd like now to talk about Bannerman. We've been around since 2006. We're very well known in the sector. This slide gives an overview. I'll move through these slides very quickly, but I'd really encourage the audience to go to our ASX platform and go to our website, bannermanresources.com, to have a look at these slides in detail. I'll point out 2 things on this slide. The first one is, if you look at our share price chart, the first 2/3 of that chart shows you what it's like to be in a bear market. Investors do not want to invest in a bear market because it's very hard to predict how long that flat line is going to last. And unless you're incredibly patient, most investors prefer to wait until there's momentum. And that's really what we're starting to see in the right-hand third of that graph. Bannerman, with the rest of the sector, has received a re-rating. We're now seeing our volume up. We're seeing the velocity of funds into the sector increase dramatically. And we are starting to attract generalist investors, as I mentioned before. The other point I'd make about Bannerman is we've got a very strong balance sheet. We've got more than $13 million in cash at the moment, and we have no debt. Good register coverage with institutional investors and a very strong board. A quick overview to our Etango project in Namibia. So look, it's a world-class scale uranium asset. It's one of the largest undeveloped assets in the world. Our total resource is 271 million pounds. And that comes with a low technical risk because it's a very advanced asset. We've taken it all the way through to definitive feasibility study and pilot plant. There's excellent supporting infrastructure. We're very, very happy to be in Namibia. And what we now introduce, as I will talk to in the next few slides, is a high level of scalability with this project. A busy slide for you to review at your leisure, but what this really shows is our journey as a company started in 2006, continued through all of the advanced feasibility work that I described, and just recently has branched into 2 distinct pathways. The first pathway is our asset as originally conceived. That's a giant-sized development of this enormous ore body. Average production anticipated of 7.2 million pounds per annum. That's enough to service 16 to 17 conventional nuclear reactors. So this is an asset that's big enough that can make or break an entire nation-scale rollout of nuclear power. So strategically, very, very important. But what we've also done recently is created this new path with the Etango 8, which is what I'd like to talk to in the next few slides. So introducing Etango 8. We've just put out a scoping study last year. We're currently working on a PFS. The point that I'd make to this slide is there's an enormous inventory of data that's been completed on the project already. So our technical and feasibility work from here is already proceeding along a path that's been well made for us because of the larger scale project that's been developed. You can see detailed information from our website, and that's a selection of these slides. I'll just cover some of the key points now and leave a bit of time for questions. These are some of the physical outcomes from our Etango 8 development pathway. As you can see, it's still a long life mine. We've reduced the scale so that we can decrease our capital, but it's still going to produce 3.5 million pounds per annum, which still rates it as a very, very large mine in this sector and amongst the very largest development projects that are expected to come on board over the next decade in order to fill that deficit. In terms of financial returns, we've decreased our capital cost from 793 million, which was the pre-production capex for the giant-sized Etango, now down to 254 million. So a big win considering we've only halved our production. You can see from those numbers that at an assumed uranium price of $65, we're producing really solid IRR north of 20%, a very solid post-tax NPV, and we've still retained leverage to uranium prices well above that. And to give you a flavour for that, during the last uranium boom, the term contract price spent a significant number of months above $95 a pound. And when you start putting those numbers into our project, we get an exceptional post-tax NPV, and that's the leverage that this project enjoys. Next. That's a comparative chart for you to review in detail, but in the next slide, please, I've pulled out what the key differences are. It's a reduction in capex, a decrease in strip ratio and an increase in grade, improved IRR, improved NPV, reduced construction time and a simplified marketing and development. Now, what that means is Etango 8 is a game changer for our company. It's that because it gives us an alternative development pathway that enables us to get into production sooner with lower development hurdles. And once we're in production, we've got the capacity to then scale up. We can add another production processing train. We can work within the existing pit boundaries to increase production if the market requires that. And we believe that once we're in production, once we're profitable, and once we see the type of sector deficit that will open up from 2028, that's likely to be the pathway that we choose to follow. Key upside opportunities are essentially the increase in scale that I mentioned, and also we've in the PFS process, we're working on some interesting improvements to acid consumption and other reagent costs. ESG and CSR are obviously very important, as I've mentioned. For now, you can take it from me. We've got an exceptionally good position in the community in Namibia. I lived there for 5 or 6 years, so I know it well. I'm very well regarded. And if you go to our corporate Twitter account, or if you follow us on LinkedIn, you'll see the evidence of just what we've been able to create in country, which is quite remarkable. We've also got all of our environmental permitting, and we've had an environmental baseline that goes back all the way to 2008. So we're absolutely rock solid on environmental and political and local community support. That's our path forward. I think the key points from this are we're currently working on our PFS. That'll be done mid this year, and then we expect 9 to 12 months to complete a DFS, add some financing and construction time, and we believe that we'll be ready for production in 2025 as that deficit starts to really open up. That's the Bannerman team, very strong uranium financing and Namibian experience. And this is the last slide in terms of a summary. So when you look at what the Bannerman opportunity offers in the context of those very strong uranium dynamics that I talked about before, look, it's a very large project. It's 3.5 million pounds with an enormous ore body from which we can garner expansion capacity and scalability into the future. The economics are robust with low hurdles to development. I mentioned that we've got environmental approval, incredibly important in this sector, particularly when it comes with strong community and government support. We haven't even talked about Namibia, but it's really a premier uranium jurisdiction with 45 years of production history. Our project's low technical risk, and now with the Etango 8 project development pathway, we've got a streamlined pathway to development that's timed to meet the very exciting and intriguing degrees of deficit that we expect to see by 2025, but particularly by 2028 in this sector. So that's what I wanted to share with you, both from a Bannerman point of view, but also from the uranium market point of view. And I'll hand back to you, Jane. Thank you.
Wonderful. Well, thank you for the presentation, Brandon. We've had a few questions come through, so I'll jump into them. So you mentioned the potential for another uranium volatility event. Do you think that uranium price has the potential to exceed 2007 highs when combined with the thematics you discussed?
Well, it always does have that potential. I'm not saying that that's necessarily a good thing for the industry, though. I think obviously investors would be delighted to see a spot price exceed $136 a pound, which was the 2007 record. But that's not something that I'm gunning for, because that level of volatility is not helpful in the sector. It can have a distortionate effect that can both distort the supply and the demand side of the sector. What I would prefer to see would be an elongated, sustained repricing at or above $80 a pound. And I think that in the longer term, that's what the sector is going to need if you start to have the more optimistic view of demand, as I do, because of those factors.
Okay, and why are you expecting reactor requirements to increase? Aren't reactors more likely to close, especially in the US and Europe?
There are certain markets where reactors are closing. However, that's heavily outweighed by, in particular, China, where if we just use their 14th five-year plan numbers, they're growing from 50 gigawatts of installed capacity to 70 gigawatts of installed capacity by 2025. But a number of their government-associated institutes are putting much, much bigger numbers. So from 70 gigawatts, they're looking for 200 gigawatts by 2035. And as I say, my modelling suggests that it'll be closer to 300 gigawatts beyond 2040. So a reactor closing here and there in the US and in Europe, whilst it gets a lot of attention and it certainly gets a lot of publicity, it's just absolutely dwarfed by the growth in China. And we haven't even talked about India. We haven't talked about Russia. We haven't talked about Africa, Middle East. Reactor growth is attractive in all of those new markets as well.
Thank you. And are you seeing political resistance to uranium mining and nuclear power starting to change?
Nuclear power, yes, definitely. And hopefully that came through, or the dynamics and the reasons why that's the case came through in the presentation. What has really changed at a political level is it's in most countries, and unfortunately I don't include Australia just yet, but in most countries it's no longer politically taboo to talk about nuclear power. And the countries where it is, in particular Germany, have got serious egg on their faces. So Germany phased out nuclear power as a knee-jerk reaction to the Fukushima accident. And what we've seen then is a doubling of the electricity costs, and their emissions have increased. And Germany's in the top 10 coal-burning nations in the world. And for a country that sits in the middle of the EU, that's an absolute disgrace. And it's simply because they've turned their back on nuclear. So that is the poster child of how not to do decarbonisation. And I think that's really influencing a number of governments and politicians around the world. As for uranium mining, remarkably, we're seeing really the reverse at the moment. So unfortunately, we've seen uranium mining banned in Sweden, where they've got good deposits in Kyrgyzstan. It looks like they're going to ban uranium mining in Greenland. As we know, there's a uranium mining ban in Queensland, Western Australia, Victoria, New South Wales, Tasmania. So that isn't helpful for the sector, but it certainly isn't helpful for the world, which is going to need that uranium to tackle climate change. And so nuclear power can play that role. Now, from an investor's point of view, unless you were unfortunately invested in a company that had a project in Greenland or Sweden or Kyrgyzstan, this is only a good thing, because it means that the uranium projects that are left standing, particularly those in rock solid uranium jurisdictions such as Canada and Namibia, those projects have got a bigger role to play. And in a sense, what this political ludicrousy is doing is it's creating greater opportunities and cutting off the competition for projects such as ours and the existing producers in Canada and also Kazakhstan.
There's been quite a few questions coming through just on the processing of uranium. So is heap leach processing common?
No, it's not common. Obviously, it's very common in other commodities, particularly very large projects. And it's had some failures in the sector as well. So sometimes I get asked the question, why did Bannerman invest so much money and effort in our pilot plant project? And you can see pictures of it in the presentation, but also on our website. So we ran that pilot plant project for 3 years. And that was because other heap leaching in other sectors and to a degree in uranium has had problems. Now, we were always very confident because essentially what we do is we take a granite and we crush it into gravel and then put it in a heap leach. So the material looks like what you'd see in the bottom of a fish tank. The sorts of problems that you can get with heap leaching, in particular from clays or silts, problems with mineralogy, problems with metallurgy, none of those exist whatsoever. So we've got a very unique opportunity. Now, it's one thing for us to know that, but we needed to be able to demonstrate that to financiers, investors. So that's why we did such an extensive pilot test program to really demonstrate beyond all doubt and beyond all risk that we've got a unique but very amenable heap leaching process.
And you talked about your presence in Namibia. So how is the relationship with the Mines Department? Are they similar to sort of the Australian, say the West Australian Mines Department?
Well, I'd say that they're more similar to a West Australian Mines Department than in most other parts of Africa. They're efficient. Anyone who's been to the geological survey in Namibia always comes away amazed at how good it is. And I think that's an analogue for Namibia in the African continent generally. Like, it's just a wonderful, wonderful place. And with Botswana, it's the shining light of Africa. So our relationship is very good. We've always received very good support. They understand us. We've been there since 2006. So it's a long relationship. We've always operated with integrity and we're recognised for that.
I've actually been there myself and met with my Minister for Mines, so I agree with you. But Brandon, look,
it's such a nice place, huh?
Beautiful. I love it. But I think that's all we've got time for today. So thank you for joining us today, Brandon.
Thank you very much for the opportunity, and thanks to everyone out there who's tuned in. I hope it's been a great session. I really enjoyed the earlier presentations as well. Thank you again, Jane.